All right, I'm going to wait another minute or two, see who joins us. Hi, Tyler.
Hey, how you doing?
All right, just me and you so far. Was that how it was the last time? Just the two of us? We had other people, didn't we?
No, there are other people for sure.
Okay, we'll give them another minute or so to show up here. Where are you located these days? You're in town here?
Yeah, I'm in Isla Vista.
All right. No better place to be. Boy, the weather. People are calling me from all over the country whining about the bad weather they have. We are really lucky right now.
Yeah, yeah, it's like really hot.
Yeah, Seattle's good. This is what's called climate change, Tyler.
Think so?
I do. I do. I really do. Been
Yeah.
been talking about it for 40 years, and we have to expect these warmer temperatures and these harsher storms and things. All right. Well, I tell you
Luckily,
what.
we're luckily it's pretty temperate out here.
Yeah, yeah, yeah. We're not going to suffer too much. All right. I'm just getting comfortable in my easy chair here. All right. Okay. I guess we can just get started then, you and me, and see if anybody joins us. Okay.
All right.
So, with that in mind, let me try to share the screen. Can you see the PowerPoint, Tyler?
Yeah, I can.
All right. Let me set this thing up my way. How you doing with the debits and credits? You feel pretty good with them?
Oh yeah, yeah, for sure.
Okay, that's a big step in the right direction here. Okay. All right, chapter 3, accounting system. All right. They talk about the operating cycle. It begins when you buy things and then you pay cash and you get money back. And we can skip this slide here. The operating cycle. The long life of a company can be reported over a series of shorter time periods. What they're talking here is you have a company that has an eternal life. A corporation is assumed to have an eternal life, but you can break down their results within shorter periods of times, like months or quarters or years. Recognition issues. When do you record the impacts of an activity? And we're on an accrual base here. We record revenues when they're incurred, not when they're paid, when they're incurred. And the same thing with expenses when we incur them. Measurement issues, what amounts should be recognized? Huh? Boy, they give you some complicated definitions here. Revenues, increase in assets or settlement of liabilities from ongoing. Boy, that's a fancy way of saying we have what's on the balance sheet. Sales, expenses, gains and losses. Gains and losses are non-operating type activity. Gains or losses are non-operating. Interest income would be an example of a gain. Interest expense would be kind of a loss. If they sold off part of the company, that would be a gain or a loss. That would be outside of the purview of the operating. And they're showing you a simple statement of account here, statement of income for Chipotle's. And again, they're talking about what's in different things. You can see their big expense on sales of 2 billion. That's 2 billion actually with the three zeros. They spend 738 million on supplies. That's napkins and food and soda and everything else. So they're showing us here their income from operations. Okay, income from operations. That is your sales revenue side and your expense side. Anything after operations, we're going to call a gain or a loss. And that's what we have here. We have a gain on the disposal of assets, which is not part of operating right now. And I'll show you one other thing of interest here. They have net income of 215. They divide that by the number of outstanding shares, 31,217,000, and their earnings per share is $6.89. Now, if you're a shareholder, you can say to yourself, that's 689 that they could return to me in the form of a dividend. Or if they don't do that, hopefully they use it to really grow the business into an either greater performing company. Operating expenses. Those expenses that are in the normal course of business, okay? There's a difference between expenses and expenditures. Expenses do not necessarily result in cash. You had employees who worked the last week of the month. That's an expense, even though you're not paying them for a while. And an expenditure is any outgo of cash for whatever reason, okay? Expenditures versus expenses. And guess what kind of restaurant expenses would you expect to see? Food and beverage, salaries, wages. Hi, Tommy. We're just starting off here with Chipotle. Chipotle is going to be our guide for this session today. And we were just looking at their income statement. How are activities recognized? Cash basis. We're not going to talk about cash basis. We're going to totally ignore that. We don't teach cash basis here. Cash basis accounting, another definition I have for that is put yourself out of business accounting. If you run your business on a cash basis, you'll never be able to really understand how well you're doing. You'll never be able to borrow money. No one's going to loan money to a company on a cash basis. We do everything on an accrual basis, meaning assets, liabilities, revenues, and expenses are recognized when the transaction that causes them occurred, not necessarily when cash is paid or received. And that's an important consideration. We need to understand accrual accounting. And it's a requirement, it's a GAAP requirement. It's a generally accepted accounting principle that financial statements are prepared on an accrual basis. I mean, do you really want to have a system where you sold me $1 million worth of things in June, but I'm not going to pay you until August? That's the deal we have. And then you sell me the million and you don't report that on your income statement because under a cash basis, you wait till you get the money. You can see what a total mismatch that would be. Here, we're going to talk a little bit about revenue realization principles. I prefer the word recognition principle. So we're talking about a caterer delivering food, and you could receive the cash before you do any work. You could receive the cash when you actually deliver the food, or you could receive the cash after the food is delivered. In all three accounts, you only record the revenue when the food is actually delivered. Okay? So we're going to deal with how to handle if we get paid in advance or paid after. The revenue principle. When cash is received on the date the revenue is earned, the following entry. Well, we know this journal entry. We debit cash and credit sales. Debit cash, credit sales. No entry, no adjusting entry is needed. We just record it like that. Now, what if the cash occurs? What if we receive the cash in advance? That's called unearned revenue. Unearned revenue. It means that we received money in advance for work we've not performed yet or products we've not delivered yet. Unearned revenue is credited. You debit cash, you credit unearned revenue. Unearned revenue is a liability. We don't owe anybody money. We owe them services. We owe them the food that they ordered to be delivered in the future. My favorite example of unearned liabilities, I'm a big sports fan, the Dodgers. You send the Los Angeles Dodgers a check for $6,000 in January, they get your money, they debit cash, but they don't play baseball in the winter. So they credit this liability account, and as the 6-month season winds down, they remove the unearned revenue into earned income, okay? Cash first, revenue later. And that's what we have here. Debit cash, credit unearned revenue. Then when they deliver the goods, that's when they're going to record the revenue. They're going to debit the unearned revenue and credit the regular revenue, service revenue. So unearned revenue. First received later. And here's a more normal situation, right? Cash is received after you deliver the goods. You order some food, catering a wedding or something. They deliver the goods to the wedding and you debit accounts receivable, you credit revenue, and the deal is you pay them later. That's a very normal statement there. Nothing tricky about that. When the cash is received, the accounts payable is then reduced. We debit cash, credit accounts receivable. So this is pretty basic information. Revenue first, cash later. The same thing with expenses, Tyler. Same thing with expenses. You record the expenses on the moment you perform the duty. So this was a repair job. When did you do the repairs? That's where you record the revenue, where you did the repairs. If you got paid beforehand, we don't care. If you got paid afterwards, we don't care. What we do care is when you did the job. The expense matching principles requires the costs incurred to generate revenues must be recognized in the same period. That's called the matching principle. The matching principle. You're matching revenues and expenses. So when you get that question on the test, what's the matching principle? You're matching revenues and expenses. So if you get paid the day you did the work, that's it, not a problem. Debit the expense, credit cash. Somebody in our office at the accounting department, the copy machine wasn't working. So we called a repair guy in. He came in, he fixed the machine, and we handed him a check. That's what we're talking about right here. But if we paid the money beforehand, that's called a prepaid expense. Prepaid expense. My favorite example is insurance. You wrote a check to buy insurance, and you wrote that check in December, and that policy covers you the next year. The cash was paid before the expense was incurred. So we have a prepaid asset on our hands. We're going to debit prepaid expense, credit cash. And what we're going to do is every month, we're going to take 1/12 of that expense and put it into expense, reducing the prepaid. Okay? Prepaid expense. The other one, you can also, let me also point out that a prepaid expense is the same exact thing as unearned revenue. They're the same thing, depending on what side of the transaction you are. If you're the one buying something in advance, that's a prepaid expense to you, an asset, prepaid assets. To the person who receives the money in advance, that's unearned revenue, and that's a liability. If cash is paid afterwards, and this again is pretty typical, the guy came in, he repaired our machine, and he handed me a bill, and I turned it over to the school, and the school paid it a month later. Debit the expense, credit the payable. And then when we pay it, there we go. Now we debit the payable, credit the cash. So the purpose of this little drill here was to emphasize accrual accounting. You record events when they occur, not necessarily when the cash has changed hands. And now we're getting into debits and credits again, debits and credits. And you have to just simply learn these at your own pace until they are in your skull. Assets debit for increase, liabilities go up with a credit, and so does capital. Assets go up with a debit. Assets increase with a debit. Liabilities and any capital account increases with a credit. These are the rules of debits and credits. Debit and credit just means left and right. It doesn't mean more, it doesn't mean less, it doesn't mean increase, decrease. It just means left or right. And you just have to understand the world of debits and credits. Now, when we get into sales and expenses, sales have a credit balance, expenses have a normal debit balance. When I say a normal balance, that's the side left or right that increases the number. So revenues, when revenues increase, it's done through the credit side. Expenses increase through the debit side. Retained earnings are part of capital, so they will go up with an increase on the credit side. And you just have to study, you just have to study like crazy to get that little bit of information in your head. And it will be a little bit tricky at first. Here's a mnemonic, if you like, mnemonics. After eating dinner, comma, let's read comics. After eating dinner, assets, expenses, expenses, and dividends. Let's read comics, liabilities, revenue, capital. Just a little tip there, maybe that'll help. So let's look at some transactions. Chipotle purchased food for $207,700. They paid $167,700 in cash. So that means they're going to owe $40,000. Okay, so the cash is going to go down by $167,700. So let's take a look at it, please. Purchase food, it costs $207,000. That's what they charge us for the food. $207,700. The deal is, though, I had to pay $167,000 in cash. So we credit cash and we reduce cash with a credit, and we increase accounts payable with a credit. And here it is in T accounts. We had a beginning balance in cash of $349,600. We now spent $167,000. So the credit reduces cash, the debit to supplies increases supplies, and the credit to accounts payable increases accounts payable. Okay. At the beginning of January, they paid in advance for 6 months of rent, $32,000 insurance, and $18,000 for advertising. They paid these all in advance. So you would debit an account called prepaid rent, and then you debit prepaid insurance, then you debit prepaid advertising. All of them are prepaid expenses. Here, they're just going to put them all into prepaid expenses, which is okay. So they paid in advance, 36, 32, and 18. That adds up to $86,000, right? 36 and 32 is 68. Yeah, 80. Actually, it doesn't add up quite right. Yeah. Okay, $86,000. Again, I bring your attention to the T accounts. Now we reduced cash with a credit and increased prepaid expenses with a debit. During the first quarter, just want to see something here. During the first quarter, Chipotle sold $619,300 worth of food. $4,000 went to universities on account. The rest was received in cash. Boy, they don't give out much credit, do they, Chipotle's? Only $4,000 in credit. So what happened here? We have a sale of $619,300, an increase of cash with a debit, accounts receivable. And again, you can look at your T accounts for reinforcement. Cash went up with the debit. Receivables went up with the debit for that little bit of $4,000 they extended. And there is our revenue, credit. During the month, they paid for some management training expenses, general and admin expense. You would normally debit an account that's called maybe management training or continuing education. Here, they call it G&A expense. That's okay. G&A expense, credit cash. Expenses have a normal debit balance, and a normal debit balance means that's the side of the T account that increases it. The normal balance is the side of the T account that increases the number. Chipotle paid employees who worked this quarter for 138 and last quarter for 91.5. And that last quarter had been accrued. The last week of the month, last month, people worked 91,500, but they did not get paid in the prior month. They're going to get paid this month. So the 91.5 had to be accrued last month. Take a peek at it. What is the total expense for this month? For this month, it's 138,600. That's what they're saying for this quarter. They had accrued the 91.5 last quarter. At that time, they debited salaries and wages expense and credited the accrued payables, which they did, and now we're taking that out. So it's a debit to the expense for 138.6, debit to the accrual from last month, and the total cash outlay is 230,100. And you can see how they're laying themselves out now in the T accounts. Chipotle sold some land costing 11,900 at a loss of 1,300. Oh, so here they're making us think a little bit. They sold land costing 11,900 at a loss of 1,300. So let's see what we have here. Well, we have a three-line journal entry. Sold land for cash. Well, the cash was 10,600, and they're telling you they sold it at a loss, so we can drop that loss right in there, and then that makes the property equipment value 11,900. In other words, we had this land valued on our financial statements at 11,900. We were only to get 10,600 for it. Chipotle received 3,300. Customers are paying their accounts. This is just normal, simple business. They build their customers. Now, a month or two later, they're getting paid. We debit cash and credit accounts receivable. And they had to pay for supplies on account, and nobody had money, which is what that means. When you see on account, you know the transaction is going to be either accounts receivable or accounts payable. Ask yourself, are we receiving money or are we going to be paying money? Well, clearly it says we paid. So we reduce accounts payable with a debit and reduce cash with a credit. During the quarter, Chipotle paid 10,000 for utilities and 48,000 for 600 for the maintenance. And they're calling the utilities occupancy expense and the maintenance other operating. So you just debit your two expenses, credit cash, and off you go with that one. They received some investment income earned during the quarter, huh? Well, cash, and you credit investment income. And this would be an example of non-operating, Tyler, non-operating. That would go below the the operating profit line.
Got it.
During the quarter, Chipotle sold gift cards to customers for 15,400. This is your classic unearned revenue. Unearned revenue. You went into Chipotle's and you bought $100 gift card, and maybe you gave it as a gift to your nephew or something, and the store never saw that card appear again. That's unearned revenue. They're going to record the revenue when the card is used. In the meantime, any money that Target gets in advance is unearned revenue. It becomes that liability. So anyway, they took us through a whole bunch of transactions, not all of them, and now they've posted everything to the T accounts. There's your cash T account. Looks like it ends up with the 15,400, they're telling us. So now that we've entered all the transactions, we now have the balances of each account. We just added the two columns and the high man wins. So we have cash and we have short-term investments. So the first two lines here, those are your assets. Looks like we have three, count them, 3, 4, 5 liability accounts, and we have 3 capital accounts, retained earnings. And on the income side, the income statement side, we had 2 types of revenues and various expenses. So we're going to take these balances, the 370, the 113.7, the 847, 100, and we're going to drop them into our trial balance, And the only thing this does for us is it proves that the debits equal the credits. That's all it does. But it serves a very super important job. And that is, it's where we're going to eventually prepare the financial statements. They're going to come right through the trial balance. How are financial statements prepared and analyzed? The income statement, that's just revenues minus expenses. It's as simple as that. As you get more and more in the class, you'll see it expand quite a lot, but it still boils down to just sales minus expenses. The statement of owner's equity, beginning plus income minus dividends gives you the ending. You have to bide your time, BIDE, beginning retained earnings plus net income minus dividends declared, all go through retained earnings, okay? The balance sheet, assets equals liabilities plus equity. The balance sheet is pretty much a representation of the accounting equation. And then your statement of cash flows. You don't have to worry about doing this statement right now. We have an entire chapter coming up on it. Just understand you have operating cash flows, investing, and financing cash flows. The operating activities, the normal course of business. Investing, you bought a big piece of equipment or you bought stock in another company. Financing, you either borrowed money or issued stock. And what they're showing you here is the linking of the statements. You have to do the you have to do the income statement first, because you're going to take that net income number down and throw it into the beginning balance. You're going to take that net income and you're going to add it to the beginning balance, and you're going to subtract any dividends to get the ending. And once you have the ending retained earnings balance, then you just bring that over to your balance sheet. And the cash flow statement simply takes the change in cash. If cash was $1 million and then went to $1.3 million, you have an increase in cash, and the cash flow statement tells management how much was due to operating, investing, and financing. An important statement. Look at your income statement. It's presented to highlight the structure, but note it's based on unadjusted balance. Oh, I'm sorry. Turn this off. So they're showing us an unadjusted income statement. Unadjusted means that they haven't, like it said, they haven't really checked it out yet. So this could be called a preliminary. And what do we have? We have sales of 619 minus operating expenses. That gives you income from operations. And then you have the below the line stuff, the investment income they talked about, and the loss on the disposal of the assets. Actually, now disposal of fixed assets is part of operating, but that's not going to affect us here. So there's their income before income taxes, and eventually they're going to have to pay about 30% of that. So a simple look at an income statement. Net profit margin. Whoa, companies always are looking at this, huh? Net profit margin. In this example here, this company had a profit of 215,000. 215,000, they're giving us that, on sales of 2269. Yeah, they're giving it to us for the whole year. So the net income was 215. If we divide the net income by the sales, we're gonna come up with a percentage of 9.47%. That means that for every dollar of sales that Chipotle had, they generated 9.5 cents. So to me, that sounds like a pretty good return, huh? Especially in this era of incredibly low interest rates. This is one of the first component percentages in your first FSA, and the FSA is coming. Hey, Tyler, when we had this class interrupted before, did we ever get up to the FSAs at all? I don't think we did we?
I don't know. I might not have been there for that. I don't remember it.
Yeah, I don't think we did. But like I said, the pandemic hit, and a lot of students left. And we didn't get that far. Okay, and that's kind of the end of chapter 3. I'm pretty sure you're pretty up to snuff on this stuff. I would guess, Tyler. Am I correct?
Yeah, and this is like what they cover in accounting 110.
Yes, exactly.
So I mean, this is like the third time that I've seen it myself.
Yep, yep. You can't pound it in enough, Tyler. So some of the students who did not take 110 are going to be struggling for a while with the debits and credits. And so, taking 110 was a wise decision. So, you have any questions or comments about this today, Tyler? Anything?
Um, so, and this is kind of a dumb question, but what's the difference between? So I know that there's net income, which
Yep.
is your sales minus expenses.
Yes.
And then there's sales, of course, and then there's also retained earnings. So what's the difference between, I guess, sales, retained earnings, and net income? Like, how do you
Okay.
differentiate?
Okay. That's a real good question. That's a real good question. I'll show you over here. Okay. Sales are just sales. Net income is your sales minus your expenses. At the end of the month, that money, those sales and those expenses are going to be rolled up into retained earnings. Think of it this way, Tyler. You began a business 10 years ago, okay? And at that point, you had no activity, so there was no retained earnings. You then ran your business for a year, and you came up with a profit of $10,000. That $10,000 will eventually be credited to retained earnings. The next month you had another profit, that gets credited to retained earnings. Retained earnings is simply a part of capital. It's a part of capital. It's part of your stockholders' equity, and it's used to record the profits of your business every month. And if you give out dividends, you debit retained earnings. So retained earnings is just a portion, is just a component of capital. Does that make a little bit of sense?
Yeah, that kind of makes sense.
Yeah, retained earnings is just part of capital. You have this company. This means here, Tyler, if you look at that number on the bottom, 668,500 plus 3 zeros, so that's $668 million of profits that Chipotle has generated year after year after year after year. That's all that means. All right. All right. We got a motion to end the meeting then, Tyler?
Yeah, I'll allow it.
All right. Well, what's today? Today's Friday already. All right. We hopefully see you on Monday then. Okay, pal?
All right, see you Monday.
Hey, you take care. Bye bye.
You too, bye.
Shoot.